Hi there, welcome to Kneppy Invest. I have recorded 3 videos that I plan to release today and over the next 2 days because I am working at my professional job and those shifts are 12 hours long. So I don't typically record videos on those days. So I plan ahead, but the markets are really interesting right now. Not only the equity markets, but the bond markets are really interesting. Commodities are interesting as well. So I thought I would do a bit of an update video on what we are seeing in these markets right now. Now, the other thing I should point out is I had planned to do some other standalone videos on quite a few companies. I had planned to do a video on what's it called? PIQ? Totally forget the name of the company. Proteomics, PIQ. And the main reason behind that is because they released an interesting announcement last week and the share price rose 23% on the day. And I just want to have or do a little bit of research on that company. I have no idea what proteomics does, but the market liked it. Also want to do standalone video on Avita Health, or Vita Medical, whatever it's called. Their share price fell a fair bit yesterday, and I haven't really dug deeply into it. Share price actually fell 20%. Also, had planned to do a video on Qantas, but I might actually cancel that planned video. And I also want to do a video on RPM Global. They actually did an upgrade, profit upgrade, but share price actually went backwards after a profit upgrade, which is very unusual. Here is their chart. Share price actually dropped 1% yesterday, a further 0.34% today. And I also want to do a standalone video on Noxo Farm, NOX. This is, well, probably should be careful what I say here. Yesterday was probably the most obvious insider trading I have ever seen. Share price on the Tuesday, the 3rd of October, rose 47.6% before the company went into a trading halt. And then, of course, the trading halt was for some good stuff. And I just wanted to talk about that or do a standalone video on that company. And that might have to wait quite a few days, maybe even like 5 or 6 days before you see that particular video, because I want to do this video today on the state of the markets because it is really interesting out there. I also show you some interesting tweets because I wanted some clarity around what is happening on the bond markets right now. That is probably the most interesting thing. And what's driving the bond markets higher, so bond yields are going higher, I think is the reason why we are seeing carnage on the equity markets. So if we have a look at the XJO right now, and this is another reason I wanted to show you this, is the XJO has fallen just below a support zone. That support zone was between 6,900 and 7,000. And at close of trading on Wednesday, the 4th of October, the XJO finished at 6,890. So this is a potential bearish signal. Now, I would like confirmation over the next few days, but the XJO has fallen a fair bit over the past few weeks. So it fell 2.9% 3 weeks ago, another 0.3% last week, and already in the first 3 trading days this week, down 2.25%. So fair bit of negativity in the market right now, or maybe you could say a fair bit of negative sentiment. However, if we do see a bit of good buying coming in tomorrow, Thursday, the 5th of October, maybe this is just the bottom of the downward cycle, the downward blip in the market. So maybe this is just like back in March, where the XJO did fall to 6,900, or back in January, where the XJO did fall to 6,900. Now, if it continues to fall, the next support level is around about 6,400, which were the double lows we saw back in June and September, October of last year. But it does look really bearish right now. Even if we have a look at the XEO, and the XEO and XGO sort of mirror each other, fairly similar. I can see the same signal here. Now, I typically look at the XGO, but the XAO, which is the all ordinaries, we also see the XAO right on that support level at 7,085. But if we dig a little bit deeper and look at the small ordinaries, small cap ordinaries, this looks way more bearish. In fact, the small ordinaries, which is XSO, is still in a downtrend. The XJO and XAO have been going sideways for over a year, but the XSO small caps are definitely in a downtrend. And if the XSO falls below about 2,600, say if it goes to about 2,560, that will be very bearish. So not a lot of positive sentiment in the small caps, which is sort of understandable. Most investors, well, not most, but a lot of investors are going defensive right now and have been going defensive over the past year and a half and prefer Woolworths, which is ridiculously overvalued right now, even the banks. Also, the American markets are starting to look a little bit more bearish. Now, the NASDAQ has been helped by AI, but I did have a look at some AI stocks. Not talking about Microsoft and companies like that. And the whole reason why we haven't seen a massive collapse in NASDAQ is because those big cap companies have held relatively strong. In fact, the other day, I think the Dow Jones was down about 1%, while the NASDAQ was up a little bit because of those big companies. So if we take a look at the Dow Jones, it looks way more bearish than the NASDAQ. And even if we have a look at the S&P 500, that looks a little bit more bearish as the NASDAQ. And the main reason is because those big companies are holding strong on the NASDAQ. And if we go even deeper, look at the Russell 3000, that's starting to look bearish. And the Russell 2000, that's probably the bearish of them more, but still, that has to fall below 1,640 before that gets really, really bearish. The other thing is when we look at, say, gold, it's dropped a lot. I think the main reason why gold has dropped a lot in the past week, almost, it's about a week, is because of what's happening on the bond markets, which I haven't even showed you yet. So that's the whole reason I'm doing this video, is because of bond markets. But gold has completely collapsed over the past 7 trading days. Uranium's down today, so first down day for a while, I think. Cryptocurrencies holding a little bit stronger. So there's a little bit of a. Some people have called cryptocurrencies the new gold, but they do completely different things. Copper looks sort of nearish. I was going to say nearish, neutral to bearish. And even US oil has fallen for the last 5 days. And coal has collapsed down 4.3%. So that was starting to look a little bit more bullish, but collapsed now. And what else do I have here? Iron ore. Iron ore is down a little bit as well. Now onto the bond market. So we've got the 10-year, 30-year American, also the 3-month. We also have the 5-year and just the 10-year Australian. So let's have a look at the 10 years of both the American and Australian. And for some reason, the bond yield is just going nuts over the past, particularly the last 3 days. In fact, the American 10-year bonds have gone from 4.6% to nearly 4.9%, while the Australian 10 years have gone from around about 4.432 to 4.619, which may not seem a lot, but that is a lot. And about 2 weeks ago, it did pull through. Both the Australian and American 10 years pulled through a resistance level. And I'll discuss why the bond yields are rising. I'm unsure. I don't know. I'm not an expert in bonds, but this is the bond market saying, I think the way I look at it, the bond market is saying that they don't think inflation is going to be under control. There is a possible another spike in inflation for some reason. I don't know. But they do expect that interest rates won't be decreasing. That's what they're saying, I think, here. There could be some other reasons, but that's what I would explain it as, that the bond market just doesn't think inflation will be significantly lower, and they don't think interest rates will be coming down within the next 6 months or so, maybe even longer. I did hear someone say they expect interest rates to start decreasing at the end of this year or start of next year. I think that's absolutely ridiculous unless we see the economies collapse around the world within the next 2 months, which maybe it's possible, but the bond market is not seeing that or saying that. And the bond market tends to be the smartest market, in my opinion. Always listen to the bond market. So really interesting. And even the 30 years just gone bonkers over the past few years. That's the American 30-year. And TLT, which is the Treasury Bond ETF. So you buy this when you think bond yields or interest rates are going to start to decrease. This is what you buy. And the other thing I probably should show you is, sort of like that. This is the, what's this one? The generic government 10-year. So if we look at that, actually I won't show you that because that tweet actually did exactly what I wanted to show you. So let's have a look at some interesting tweets. And the first one here is from the Mad King. For finance professionals who commenced their careers after 1985, including this person, a continuous decline in rates has been the norm. We're rarely encountered more than one standard deviation, and when we did, we knew the Fed's next move. Yet now we find ourselves approaching 4 standard deviations. We are in uncharted territories, and expecting a soon Fed's pivot is almost delusional. So that's, again, I don't think the market or the bond market is saying we don't expect the Fed to pivot. And this is really interesting that, yeah, the bond market has been or was in a 40-year bull run. So even though it's going down here, just remember, bond yields and bond prices are inversely related. So this is bond yields. It's been going down for 40 years, or did go down for 40 years, which means bond prices were going up for 40 years. That's why it was a bond market bull market, or bond bull market. A great time to be invested in bonds. And if you do think bonds will start going down, or the bond yields will start going down, that's a time to buy. Some interesting comments here. Fed is going to be forced to pivot by end of year. And the question was why? So that's the question here, is when will the Fed pivot? Will they pivot at all? The other thing the central banks are really concerned with is what happened in the 70s. So people just think that inflation was persistently high during the 70s. It was not. Inflation was not persistently high during the 70s. I'm wondering if I can actually show you this. Inflation history. No, I don't want to do that. I want, this is what I want. Inflation. I don't know which one to look at. See if this works. We'll get rid of the moving averages. Okay, so yeah, this works. I just want to get rid of this one moving average. So in the 70s, we had a spike in inflation back in 1974. So inflation went from 3% to about 12%. And you can see inflation fell significantly during the last part of last part of 1974 into 1975. In fact, inflation fell from about 12% back down to 5%, which is a fairly big decrease in inflation. And if I remember correctly, and I haven't done much research on this, the Fed pivoted during that point and started lowering interest rates. Probably could put interest rates on this chart as well. I want to see if I can do that. Interest rates. I'll see if I can do this. I'm not sure if I can. No, it doesn't quite work. Doesn't quite work. Okay. But anyway, they did decrease interest rates during that period. And then they saw another massive spike in inflation. And in fact, inflation went significantly higher than the previous peak. So inflation wasn't persistently high, although you might say 5% inflation during the trough in 1975 is still pretty high. And then Volcker came in and raised interest rates to, was it 15% or higher? And that's how, well, there is arguments saying that that wasn't the only reason why inflation fell, because of high interest rates. But anyway, in fact, look, so that's fairly similar. What's happening now? If you look right now compared to 1974, fairly similar. So everyone was rejoicing about inflation decreasing, but is that the end? And maybe the bond market is saying they now expect another peak in inflation in the next year or two. Just a possibility. I have no idea. So anyway, so this is just saying, you know, this is unusual. We haven't seen this happen since the 1980s or 1970s, 1980s. Another interesting one was this one from Lance Roberts. So this is looking at the bond yields from 1980 all the way through to now. And every single time we saw a peak in the bond yields, something happened to cause it to decrease. So the 1987 stock market crash, that was a peak in the bond yields. 1990 recession, peak. Mexican peso crisis, peak. Asian crisis, peak. Tech bubble burst, peak. GFC, peak. Euro area credit prices, wasn't really a peak there. Taper tantrum, peak. 2018 global sell-off, peak. So what's going to cause a peak now? And more than likely, it's going to be a significant recession. That's what probably they're talking about. In fact, the first reply in this particular tweet is this exact, or saying this exact same, or that exact thing. The recession's officially started after tops by a good 6 to 12 months. Rates fell prior to recessions. And in fact, there's a tweet from Tobias Carlyle talking about this. The 10-3 inversion is rocketing towards normalization. So you might think that's a good thing. It hasn't been this tight since January 3rd. 10-3 inversions have preceded the last 8 recessions, but it is the uninversion, this is the most important thing, it is the uninversion that most immediately precedes the declaration of a recession. We'll find out shortly if the correlation holds. So we usually see the inversion well before the recession, and then it uninverts, and then we go into recession. That's what he's saying. Will it hold true this time? Have to wait and see. Probably want to show you those tweets. And here's another one. I was already talking about the TLT, which is a 20-year bond share or bond ETF. And this particular tweet's talking about the massive volume coming in. Highest volume on record. Is this capitulation? Is this signaling that we are the top of the bond yields and the bottom of the TLT price? The lowest it's been since, well, probably 2007, 2008. Today alone, we have seen 60 million shares traded in this ETF. To put this in perspective, even in March 2020, daily average volume was only 25 million. In August 2011, during the debt ceiling crisis, TLT average volume was 21 million. So bond markets are experiencing a major shift. Needless to say, there's been a major shift in sentiment in the bond markets. The Fed pause is now expected through July 2024. However, at what point is this trade simply just crowded and ripe for rebound? And that's probably exactly what I'll be thinking. And then someone else just mentioned here, is it capitulation? Just what I said. I don't know. It could be capitulation, or this could be horrible, but I think more towards capitulation. So I am actually looking at TLT ETF for a possible trade. Okay, so on to explanations why bond yields are rising really quickly. Couple of tweets, and I have no idea the validity of these tweets. So this one's from Finance Lancelot. Yields are rising because the Fed is collapsing M2 money supply for the first time since the Great Depression. There are simply aren't enough dollars to cover debt issuance anymore. This will lead to a massive insolvency crisis, fully engineered by the Federal Reserve. Haven't gone through the replies. Fair few replies, 99 replies. 0% chance they will just print. That's the expectations now from people, that the Fed will just keep on printing. I don't know. And then here's one from Samantha Leduc. I have no idea who she is. Humble contributor, Bloomberg, CNBC, Yahoo Finance, curious cross-asset analysis, persistent trader on Chase, swing plus trend timeframes. Doesn't tell me who she is. Anyway, simply, okay, this is a question about why didn't bond yields rise more than inflation was 9%, or when inflation was 9%? I don't know. Why are bond yields rising so fast now that inflation has fallen? I don't know. Where do rates go from here? I don't know. Is the bond market dumber than we give it credit for? Possibly. Hope that helps. And Samantha Leduc replied, simply, bond yields are tied to supply. That sort of makes sense. So everything is tied to supply and demand. So maybe she's absolutely right. Supply of treasuries are tied to fiscal deficits. Gigantic fiscal deficit from irresponsible Congress forces Treasury to print massive paper as Fed forces to dampen the effects from inflation caused by government spending with ineffective rate hikes. So if you understand why bond yields are rising quite significantly, or have risen quite significantly over the past few days, particularly over the past few days, I'd love to hear your explanations. I'm a little bit clueless on this. I am searching, trying to find out why. I think to understand why would be quite powerful and would really increase my knowledge base, put it that way. So if you do have understanding, I'd love to hear from you. Just leave in the comment section of this video, because I'm pretty sure a lot of other people will love to hear any sort of explanation. And the last tweet I want to show you is this from Octavio Tavi Costa, who is sort of a commodity bull. And this was actually from a few days ago. When was it from? October the 3rd. No, it wasn't a few days ago. And actually, I've seen this tweet before. There is a good correlation between the NASDAQ and the 10-year Treasury up until March of this year. Then there was a sort of what do you call it? I don't know what you call it. Separation of that correlation, or disconnection of that correlation. Not sure what the correct word is. And 10-year Treasuries were falling, and then the stock market rose, NASDAQ 100. And that was back on the back of AI. And now we're starting to see NASDAQ be under a little bit more pressure. So I wouldn't be surprised to see NASDAQ fall if 10-year Treasuries continue to fall like they are. But maybe this is the bottom, as we mentioned, and maybe we'll see that red line go higher and the white line go lower, and then they'll meet up and get back into correlation. The other thing I want to show you is, we'll go back to looking at, last thing I want to show you is a couple of the AI companies. So I'm keeping a close, or I was keeping a close eye on. Whoops, we don't want monthly, we want daily. Keeping a close eye on this company, C3AI, and you can see that massive bounce in this company's share price. I don't think they're profitable. In fact, they're far from profitable. So in the past year, revenue of 266 million, loss of 268 million, and the previous year, a loss of 192 million. So this company doesn't care if they make profit or loss. They just want to increase their revenue. But we saw a massive increase in the share price of this company from January of this year all the way through to, say, the middle of the year. Share price actually increased from $10 to a high of $50. So this was sort of a poster child, one of the best poster childs of that AI hype during the first half of 2023. You can also see the massive volume as well. And I think one of the reasons why there was massive hype around this company is simply because it had AI in the name of the company, but the share price of this company has dropped a fair bit and probably has moved into a downtrend right now. In fact, the share price has moved down from the high of $50 all the way down to 24 now. So share price has halved. Some other companies, maybe, I'm not going to show you Apple, Microsoft, because those are much higher quality companies, but Apple's under a little pressure. Microsoft is under a little pressure. Probably the only one that is not under big pressure is Alphabet. That's still a nice uptrend. I'm not sure why. Yeah, sea of red on the NASDAQ overnight. Probably the other one was Unity, maybe. I'm not sure this is really AI. We did see a big bounce, not a big bounce, but it did go higher, but it's probably just a lot of other tech stocks. Trying to think of another AI company, a specific AI company, but I can't think of any right now. Anyway, that's probably all I got for this particular video. Really interesting times we now are in. In fact, it seems like it's been really interesting times over the past 3 years. Which way is the markets going to go, up or down? I don't care. Either way, I have enough cash on hand that if we do see a collapse in the markets, I will have enough cash to take positions in companies I want to take positions in. And I think it's very important at this point in time to have a watch list of those companies you want to buy if the markets do collapse. And if the markets don't collapse, that's okay. I still have a fair few holdings that can take advantage of the non-collapse in the markets. Will we go into recession? So if you remember, if you did watch at the start of the year, I made predictions, and I said we won't go into recession. I think I said America won't go into recession, which was a sort against the popular opinion at that point in time, where America is still not in a recession. But I think maybe things are moving towards that direction. But just the bond yields significantly increasing over the past week is fascinating to me, and I still don't know what. So that's all I'm going to have for this video. Interesting times. Again, if you have any more, if you can give me any more clarity, I'd love to hear from you. So leave your clarity-driven thoughts or explanations in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is professional and can speak to your own financial needs. That's it for this video. Have a good day. Bye.